Turning now, of course, to the other region that is generating a lot of headlines. Europe, the debt crisis there, and a rescue of Greece are the focus of this week's G20 meeting in the French resort town of Cannes. Well, our next guest said back in May that the fallout from Greece would be felt, of course, in European equities. And since that time, the Euro Stoxx 50 index down more than 16%. Well, joining us now is Constance Hunter. She's chief economist for Aladdin Capital Management, where she helps manage $12 billion in assets. Constance, great to have you here on Street Smart. So I don't know, you didn't put a target on it then at that point, but clearly stocks have been very hard hit since then. Is it starting to look like a buying opportunity?
I don't think quite yet, and I'll say why. If you look back at previous debt crises, if you look at the Latin America debt crisis, we had that entire lost decade of the 80s. You look at Japan, when their debt bubble burst, it took a long time to really get to the day of reckoning. We had zombie companies, So you look at what's happening in Europe, and my inclination is to say I'm not convinced a 50% haircut is enough, and so the question you have to ask is, can Greece fund themselves with a 50% haircut? Now, if it was a 75% haircut, that is so severe, I would say, yes, they can fund themselves with a 75% haircut. But human nature is to usually try to get the best deal possible. And what that means is these things drag on longer than people think.
Do you have to have a psychologist on staff at this point to actually manage money? And I mean that almost seriously, because you even mentioned human nature. If you look at some of the behavioral, many of the behavioral finance people are actually trained in psychology as well as economics, or they're just trained in psychology. And so that's a valid question. I think you certainly have to be a student of human nature and be realistic about what groups of people do in these types of situations. Now, it's possible we get something very workable out of the G20 this weekend. Clearly we came to the brink. And Papandreou, saying he wanted a no confidence vote, saying he wanted to do the referendum, pushed Europe to say for the first time it's possible Greece could leave the euro. That is a very significant shift. Which markets do you think have the best interpretation of what's actually happening there?
The bond market.
Often we're looking at the stock market. I don't know what to make of today's rally. Sometimes there's good news out of Europe and we sell off. Sometimes there's bad news and we trade up. What in the bond market do you pay close attention to? Yeah,
well, you've got to look at the sovereign yields and then even the corporate spreads. They have generally been a better indicator. And so you look at Spain had an auction today. They came in ever so slightly, I think 4 or 5 basis points better than their early September auction. There's going to be some assistance because the ECB lowered rates. But you've got to look at if the bond market is buying the deal, then you say, okay, maybe this makes some sense. But really what it comes down to is these guys have to refinance and they have to be able to fund themselves, whether it's banks, governments, companies. And if they can't do that, none of the equity rallies really make any difference.
What is the bond market telling you about the next 6 months to a year at this stage?
That we're going to have very, very slow growth.
Slow growth. Do we see another massive sell-off? Do you buy commodities here? Do you buy, what currency do you buy? What bonds do you buy?
Yeah, well, interestingly enough, I think that we may see some appreciation of the dollar, certainly against the euro. If this is the beginning of a rate hike cycle in Europe, which it very well may be, then I think there's scope for the dollar to appreciate against the euro. Going down to the 130, 125 level over the next 6 months is not out of the question. And there's still some corporate bonds that are doing very well. You've just got to pick your spots and figure out when to get in.
U.S. corporate bonds at this stage.
Mm-hmm. I would be very selective about Europe right now. I think that the risk probably outweighs the reward.
And quickly, what about U.S. Treasuries? It's a big topic of conversation, particularly after yesterday's FOMC meeting.
Mm-hmm. And it depends on what you want to achieve. If you want to park cash, certainly the short end of the curve is obviously the preferred place to be for a lot of people. And it is still the safe haven market. And I just caution you, if you look to Japan, we went down to, a below 1% on the 10-year. Now we're hovering here right around 2%. I think if things get substantially worse in Europe, you could see a 1.5% Treasury, 10-year Treasury yield. Now, is that warranted from the economy? Is the risk to reward there? It seems binary. It seems we could just as easily go to 150, or maybe Europe manages to muddle the way through, and we head back up towards a 2.5–3% level.
Right. That's where that behavioral element clearly factors in. All right, Constance, we have to leave it there, but do appreciate you joining us here on Street Smart. That was Constance Hunter of Aladdin Capital Management.